Imagine walking into a bank and being told that keep in all your money there could be a risk. Not decades from now, but today. That's the kind of blunt, no nonsense advice Stanley Druckenmiller has always been known for, cutting through the noise of conventional wisdom with the clarity of someone who has navigated the world's toughest markets. In his latest warning for 2026, Druckenmiller doesn't mince words: never keep more than $250,000 in a single bank. It's a stark reminder that even the institutions we trust most aren't immune to volatility, and that safeguarding your wealth requires vigilance, strategy, and sometimes a healthy dose of skepticism. Limiting deposits to $250,000 per bank may sound like an oddly precise piece of advice at first, but in the mind of someone like Stanley Druckenmiller, precision is everything. This is not a caution born from paranoia, but from decades of observing how financial systems can bend, fracture, and occasionally break under pressure. Most people assume that banks are vulnerable, fortified by regulations, government oversight, and deposit insurance schemes. To the casual observer, the notion that there's a threshold beyond which holding money in a single institution could be risky might seem extreme. Yet Druckenmiller's insistence on this limit reflects a deep understanding of the dynamics that govern modern banking, the fragility that can lurk beneath apparent stability, and the importance of never putting too many eggs in one basket. In the current financial landscape, it is all too easy to grow complacent. After decades of relatively smooth banking operations, people have become conditioned to trust that their money is safe behind the doors of familiar banks, especially the largest and most established ones. They see the gleaming headquarters, the long-standing brand, and assume security. But history is full of examples where even venerable institutions failed suddenly, catching depositors off guard. From the regional bank collapses to the more systemic shocks of the 2008 financial crisis, the lesson has always been clear: confidence does not equal invincibility. The $250,000 guideline is not arbitrary. It reflects the upper limit of FD insurance coverage in the United States. Deposits above that figure are not guaranteed, and in times of financial stress, having a large sum concentrated in a single bank exposes one to a potentially catastrophic risk. The risk is not just theoretical. Modern banks operate in a complex web of interdependencies, including exposure to financial instruments that can fluctuate wildly, reliance on short-term funding, and interconnectedness with other institutions both domestically and globally. When one institution encounters problems, the ripples can spread quickly, leaving depositors in precarious positions. By capping deposits to $250,000 per bank, an individual or business can significantly reduce exposure to these kinds of systemic vulnerabilities. It is a simple yet effective method to ensure that a sudden failure or liquidity issue does not wipe out a lifetime of savings. Druckenmiller has always emphasized risk management over speculation, and this principle applies to how one stores cash just as much as how one invests it. The lesson is that managing money is as much about avoiding losses as it is about generating returns, and that begins with controlling the very real and immediate risk of institutional failure. There is also a psychological element to this discipline. For many, money sitting in a single account feels safe because it is visible, accessible, and convenient. Breaking it up across multiple banks requires deliberate effort, attention, and planning. It forces an individual to confront the reality that convenience is not the same as security. This kind of mental recalibration is central to Druckenmiller's philosophy. He has always advocated for conscious decision-making and for resisting the lure of complacency that comes from perceived safety. By enforcing a cap, a depositor is compelled to diversify, to think strategically about where their money is placed, and to adopt a mindset that prioritizes preservation alongside growth. It may require more effort, more attention to detail, and perhaps even logistical maneuvering, but the payoff is tangible resilience in the face of uncertainty. Limiting deposits also encourages a broader understanding of the financial system. When an individual or business is forced to spread funds across multiple institutions, they begin to see how different banks operate, how risk is managed differently, and how financial health can vary from one institution to another. This exposure fosters a sophistication that casual depositors rarely develop. It transforms passive money holders into active participants in their own security strategy. Druckenmiller has often stressed that knowledge and awareness are forms of armor, and in banking, ignorance can be expensive. By imposing the 250,000 limit, individuals not only protect themselves, but also engage with the system in a way that builds insight and instinct, honing their ability to make prudent financial decisions under pressure. Practical implementation of this principle involves more than just opening multiple accounts. It requires careful record keeping, attention to interest rates, and an understanding of how each bank is insured and regulated. Not all banks are equal, and not all deposit accounts provide the same protections or liquidity options. By navigating these differences, a depositor develops a toolkit for managing risk that is both flexible and robust. Furthermore, this approach creates a natural buffer against market shocks and unexpected economic events. In an era where banking technology, digital platforms, and financial products are constantly evolving, having a deliberate, methodical plan for where money resides provides a steadying anchor amidst volatility. The limit is also forward-looking. It implicitly acknowledges that financial crises can emerge suddenly, often without warning. In such moments, the difference between a secure depositor and one exposed to catastrophic loss is measured in thousands or even hundreds of thousands of dollars. By proactively adhering to the 250,000 guideline, individuals are not gambling on the stability of a single institution. They are hedging against uncertainty itself. In Druckenmiller's view, this is not a conservative move, it is a strategic, intelligent one, aligning resources in a way that maximizes security while maintaining flexibility to respond to changing circumstances. It is, in essence, an exercise in controlled paranoia, recognizing that no bank, no matter how prestigious, is beyond risk, and taking steps to ensure that personal or business finances are never fully exposed. This philosophy encapsulates Druckenmiller's approach to finance at every level: respect for risk, disciplined management, and an unflinching acknowledgement of the realities of the world in which money exists. Limiting deposits to 250,000 per bank is not just about numbers. It is about mindset, strategy, and the kind of foresight that separates those who endure financial storms from those who are swept away. Diversifying across multiple financial institutions is more than just a safety measure. It is a fundamental principle of management that separates careful planners from the complacent. While the 250,000 limit per bank sets the boundary, diversification is what turns that boundary into a robust shield. Holding all of one's funds in a single bank, even if it is insured up to the legal limit, creates an invisible vulnerability. The bank could face operational disruptions, cyber attacks, or regulatory pressures, or liquidity don't necessarily trigger a collapse, but can delay access to funds, limit transactional flexibility, or erode the value of deposits in subtle ways. By spreading resources across multiple banks, an individual or business not only insulates themselves from catastrophic loss, but also gains operational agility, ensuring that financial leverage, timing, and opportunities are never hindered by a single institution's misfortune. For someone like Stanley Druckenmiller, the concept of diversification is not theoretical, it is a survival strategy honed over decades of navigating highly volatile markets. He has witnessed firsthand how quickly fortunes can shift, how confidence in a single entity can evaporate, and how systems that appear stable on the surface can unravel from within. In banking, as in investing, putting too much weight on one entity exposes an individual to systemic risk. Diversification spreads that risk, creating multiple points of resilience. It is akin to having several lifeboats rather than a single vessel that looks sturdy but could sink at the first sign of stormy waters. The more channels through which funds are distributed, the more insulated a depositor becomes against the unpredictable shocks that characterize modern finance. The practical implications of diversification extend beyond mere safety. Different banks have different structures, asset compositions, and operational models. Regional banks, for example, may focus on community lending and local markets, While national banks operate with broad exposure to commercial lending, investments, and international markets, online banks may offer higher interest rates but rely heavily on digital infrastructure. Credit unions might provide personalized service and benefits, but have limits in liquidity or operational capacity. By strategically spreading deposits among a mix of institutions, a depositor benefits from varied risk profiles, differing approaches to capital management, and distinct operational strengths. In essence, diversification transforms passive money holding into an active engagement with the financial ecosystem, where each account functions as a component of a broader security and strategy network. There is also a psychological benefit to diversification that is often overlooked. Concentrating money in a single account creates an illusion of simplicity and control, but it can breed a false sense of security. Individuals may ignore warning signs, skip due diligence, or fail to prepare for contingencies because everything feels contained and manageable. Distributing funds across multiple banks, however, requires awareness, monitoring, and engagement. It instills discipline, reinforces attentiveness, and encourages ongoing assessment of both individual institutions and the broader financial landscape. This active participation aligns with Druckenmiller's broader philosophy. Successful money management demands vigilance, strategic foresight, and a willingness to confront inconvenient realities rather than hiding behind assumptions of stability. Diversification also enhances liquidity management. By having accounts in different institutions, a depositor can optimize access to cash when needed, reducing the risk of delays or limitations during periods of high demand. If one bank experiences technical outages, regulatory freezes, or unexpected holds on transactions, the presence of funds elsewhere ensures continuity. This operational flexibility is particularly crucial for business or investors who rely on timely access to capital to seize opportunities, settle obligations, or respond to market movements. For individuals, it provides peace of mind and a buffer against disruptions that, while minor on a systemic scale, can be personally significant. Moreover, spreading funds encourages a deeper understanding of banking products, interest rates, fees, and services. Each institution has unique features and constraints. Some offer higher, yielded withdrawal options, while others provide robust customer service but lower returns. Navigating these differences enhances financial literacy, sharpens decision-making, and reinforces the principle that security is not passive, it is actively managed. Druckenmiller has often emphasized that knowledge itself is a hedge against risk. By engaging with multiple banks, depositors cultivate a nuanced understanding of their own financial ecosystem and develop instincts for spotting potential threats before they become crises. The strategic nature of diversification also aligns with long-term wealth preservation and growth. Depositing funds across multiple institutions allows the depositor to take advantage of varying interest rates, promotional offers, and specialized accounts, effectively turning risk management into an opportunity for optimization. It creates a network of financial touch points, each contributing to overall security and efficiency in volatile economic conditions. This distributed approach can mean the difference between weathering a banking crisis with minimal disruption and facing unexpected losses or operational headaches. Ultimately, diversifying deposits transforms a simple act of storing money into a sophisticated, proactive strategy. It forces engagement, builds resilience, and leverages the inherent differences among institutions to create a layered safety net. In Druckenmiller's perspective, it is not just about protecting wealth, it is about structuring resources intelligently, anticipating disruptions, and maintaining control over one's financial destiny. The discipline, foresight, and vigilance required for effectification are precisely what separate those who survive financial uncertainty from those who find themselves vulnerable when circumstances shift unexpectedly. Staying alert to banking system risks is a principle that often gets overlooked in day-to-day financial decision-making, yet it is central to the mindset of someone like Stanley Druckenmiller. While limiting deposits and diversifying across multiple institutions create tangible safeguards, Vigilance is the thread that ties these strategies together and ensures they are effective. The banking system is not a static, monolithic entity. It is a dynamic, interconnected web of financial institutions, regulatory frameworks, market pressures, and global economic forces. What appears secure today can shift in an instant as interest rates, credit conditions, regulatory changes, or even geopolitical events send ripples through institutions large and small. Recognizing that the stability of a bank is inseparable from the health of the broader system is crucial, and it is this awareness that informs Druckenmiller's call for constant attentiveness. Alertness in this context goes beyond checking account balances or monitoring fees. It involves understanding macroeconomic trends, being aware of sector-specific risks, and appreciating how systemic pressures can cascade into individual institutions. For example, a sudden spike in interest rates can strain banks with large portfolios of long-term, low-yield loans, affecting liquidity and solvency in ways that are not immediately apparent to casual depositors. Similarly, exposure to volatile financial instruments, international debt, or undercapitalized lending practices can silently undermine a bank's stability. A depositor who remains alert is constantly evaluating these signals, considering how changes in one part of the financial ecosystem could influence their own security, and taking proactive steps to mitigate exposure before a minor issue snowballs into a major problem. The lesson of vigilance is compounded by the increasing complexity of the banking landscape. Modern banks are not merely places to store money. They are multifaceted institutions engaged in lending, investing, derivatives trading, and global financial operations. Regulatory frameworks and risk management protocols exist, but they are not infallible. History shows that crises often emerge from hidden vulnerabilities or opaque exposures, leaving depositors with little warning. By maintaining a posture of alertness, individuals and businesses equip themselves to recognize early warning signs, differentiate between noise and meaningful signals, and respond in ways that preserve capital and operational flexibility. Druckenmiller's perspective emphasized that risk is ever present and that proactive awareness is the most effective tool for mitigating it. Being alert also involves continuously reassessing assumptions. Many depositors operate under the belief that banks are universally safe, that insurance schemes provide complete protection, or that past performance guarantees future stability. These assumptions are dangerous. They foster complacency, encourage blind reliance on institutional branding, and can leave people unprepared when a bank faces unexpected stress. Vigilance, by contrast, requires questioning these assumptions, seeking out credible information, and being willing to act decisively when conditions change. It transforms passive money management into an active practice, where deposits are not simply stored but strategically monitored and adjusted in response to evolving risks. Technological change adds another layer of urgency to staying alert. The rise of digital banking, online transactions, and automated financial platforms has increased convenience but also introduced new vulnerabilities. Cyber attacks, system outages, and technical failures can temporarily lock depositors out of their funds or compromise sensitive information. Awareness of these threats, combined with strategic measures like spreading funds across multiple platforms, using secure authentication methods, and keeping a portion of assets in physically accessible forms, strengthens overall resilience. Druckenmiller's insistence on alertness and both traditional banking risks and the modern digital vulnerabilities that have become integral to financial security. Furthermore, alertness encourages a forward-looking mindset. Crises rarely announce themselves in dramatic fashion. They often emerge subtly, through shifts in liquidity, changes in lending standards, or undercurrents in market confidence. Depositors who remain engaged are to recognize these early signals, adjust their allocations, and implement contingency plans. Alertness is not reactive, it is anticipatory. It transforms awareness into action, ensuring that even when the unexpected occurs, individuals are not paralyzed but prepared to respond strategically. The practice of vigilance also reinforces a disciplined approach to decision-making. In a world where financial media, social platforms, and market noise bombard people with conflicting information. Staying alert requires discernment. It is about filtering out the irrelevant, focusing on meaningful indicators, and cultivating the intuition to distinguish real threats from transient fluctuations. Druckenmiller's approach emphasizes that this discipline is not optional, it is essential. By maintaining a constant awareness of systemic risks, depositors develop a form of financial reflexes, a readiness that allows them to act swiftly and confidently when conditions demand. Being alert to banking system risks ultimately aligns with the broader philosophy of wealth preservation and strategic management. It complements deposit limits and diversification, forming a triad of defensive strategies that protect against both predictable and unforeseen dangers. Alertness creates the context in which other measures are meaningful, ensuring that deposits are not only distributed safely, but continuously monitored, evaluated, and adjusted in response to a changing financial environment. It is this combination of strategy awareness and proactive engagement that defines Druckenmiller's approach to safeguarding capital and navigating the uncertainties inherent in banking and global finance. Avoiding over-reliance on FDIC insurance alone is a concept that sounds straightforward, but carries deeper implications for anyone serious about safeguarding their wealth. FDIC coverage, while crucial, not a panacea, it protects deposits up to $250,000 per depositor per insured bank, but anything above that amount is exposed if the institution fails. Relying solely on this safety net creates a false sense of security, a comfort that can lull depositors into complacency while leaving them vulnerable to losses that are entirely avoidable. For someone like Stanley Druckenmiller, who has spent decades navigating the fragility of financial systems, depending exclusively on insurance is equivalent to assuming a parachute will always open without checking it beforehand. It is prudent to recognize the limits of institutional guarantees and to complement them with active strategies that mitigate risk before it becomes urgent or catastrophic. The danger of over-reliance is compounded by the fact that the FDIC, while historically effective, cannot change the reality that extreme systemic events could stress its resources. In moments of widespread financial turmoil, multiple banks could fail simultaneously, creating administrative delays, frozen assets, and logistical bottlenecks in the process of repayment. Although the insurance system is designed to protect the average depositor, the speed and efficiency of recovery are not instantaneous. Depositors who have concentrated wealth above insured limits in one institution may find themselves scrambling for solutions while waiting for funds to be returned. Druckenmiller's advice underscores the importance of proactive measures, recognizing that insurance is a line of defense, not a fortress, and that building personal redundancy into financial planning is critical. A strategic approach to reducing reliance on insurance starts with understanding exactly how coverage works and how it applies to different account types. Depositors often assume all funds within a bank are fully protected, but variations exist. Joint accounts, retirement accounts, trust accounts, and certain investment vehicles have different coverage rules. Awareness of these distinctions enables smarter allocation of funds, ensuring maximum protection with limits. It also reinforces the mindset that financial security is not automatic. It requires attention to detail, methodical planning, and deliberate action. By mapping out coverage limits and structuring accounts accordingly, an individual gains both peace of mind and operational control, preventing unnecessary exposure to avoidable risks. Beyond regulatory coverage, avoiding over-reliance and diversification into other forms of secure holdings. While FDIC insurance protects cash deposits, liquidity management can include short-term treasury bills, money market accounts, and other low-risk vehicles that are separate from traditional banking institutions. These alternatives provide additional layers of protection, enhance flexibility, and reduce dependency on any single regulatory framework. Druckenmiller's philosophy emphasizes redundancy, not putting all trust in a single system, but creating multiple, independent channels of security that can function even if one fails. This approach transforms passive money management, multi-layered strategy designed to withstand both expected and unexpected challenges. There is also a behavioral component to overreliance. When individuals assume their deposits are fully protected, they are less likely to monitor banks' health, reassess their positions, or implement safeguards in a timely manner. This creates a dangerous combination of complacency and exposure, especially in volatile economic periods. By recognizing the limitations of assurance, depositors adopt a mindset of vigilance, prompting them to actively evaluate institutional risk, track market developments, and maintain operational flexibility. It becomes a habit of attention and anticipation rather than one of blind faith, aligning with Druckenmiller's broader principle that risk is ever present and must be managed deliberately. Avoiding overreliance also fosters resilience in the face of technological or operational risks. Banking failures are not the only threat. System outages, cyber attacks, and regulatory delays can temporarily limit access to insured deposits. By spreading funds across institutions and complementary secure vehicles, a depositor reduces dependence on any single access point, creating multiple avenues for liquidity even in times of disruption. This approach is proactive rather than reactive, turning potential vulnerabilities into manageable elements within a comprehensive risk management framework. Moreover, this strategy instills a disciplined approach to wealth preservation. It reinforces the habit of reviewing allocations regularly, adjusting for changing economic conditions, and ensuring no single exposure could imperil financial stability. In practice, avoiding overreliance on FDIC insurance encourages a layered mindset. Deposits are protected, diversified, and actively monitored, creating a structure in which financial security is both tangible and adaptive. For someone navigating the complexities of modern finance, this layered protection is invaluable, combining regulatory safeguards with personal strategy to form a defense capable of weathering uncertainty. Ultimately, recognizing the limitations of insurance forms a seemingly passive aspect of money management into an active, strategic exercise. It is a principle that combines foresight to detail and disciplined execution. For Druckenmiller, it is not just about following rules. It is about understanding vulnerabilities, anticipating risks, and taking deliberate steps to mitigate them. Avoiding overreliance on FD insurance is a call to action, a prompt to think critically about where money resides, how it is protected, and what measures can be taken to ensure resilience against both expected and unexpected financial storms. Monitoring economic and market signals closely is a principle that turns passive financial management into an active, anticipatory practice. While limiting deposits, diversifying across institutions, staying alert to risks, and avoiding overreliance on insurance form the foundational layers of security. The ability to read and interpret economic signals is what allows an individual to adapt, respond, and even capitalize on emerging threats and opportunities. In the world of Stanley Druckenmiller, ignoring these signals is equivalent to navigating a stormy sea without a compass. The financial system is not static, it breathes, fluctuates, and reacts to forces that range from central bank policies to geopolitical tensions. By paying attention to these signals, depositors and investors gain foresight, positioning themselves to act before situations escalate from manageable to critical. Economic and market signals take many forms, both overt and subtle. Interest rate adjustments, shifts in monetary policy, changes in inflation data, employment reports, and consumer confidence indexes all provide clues about the direction of financial conditions. Even seemingly minor movements in bond yields, credit spreads, or interbank lending rates can indicate stress building within the system. For someone focused on safeguarding deposits, these indicators are not abstract charts, they are early warning signs, highlighting vulnerabilities that could affect liquidity, solvency, or the accessibility of funds. Druckenmiller's approach emphasizes the importance of connecting these dots, understanding the interplay between macroeconomic forces and institutional health, and translating that understanding into actionable decisions that protect capital. Monitoring also involves recognizing patterns that may suggest systemic risk. Banking crises rarely appear suddenly. They usually manifest gradually through indicators such as tightening credit conditions, rising default rates, increased volatility in equity markets, or unexpected regulatory interventions. By observing these patterns, a vigilant depositor can adjust allocations, redistribute funds across institutions, or shift portions of liquidity into alternative secure vehicles. This proactive stance turns awareness into a strategic advantage, reducing exposure to shocks that might otherwise seem unavoidable. Druckenmiller has consistently highlighted the importance of timing. Knowing when to act is as crucial as knowing what steps to take, and monitoring economic and market signals provides the intelligence necessary to make those timing decisions effectively. The modern financial environment amplifies the need for continuous monitoring. Globalization has interconnected markets to a degree unseen in previous generations. A banking disruption in one country can trigger ripple effects across continents. Political events, trade tensions, and natural disasters can influence currency values, capital flows, and investor confidence, affecting even domestic institutions. Keeping an eye on these developments allows a depositor to anticipate shifts in the banking landscape, positioning assets in a way that minimizes exposure while maintaining operational flexibility. Druckenmiller's insistence on vigilance recognizes that no bank operates in isolation. External shocks, if ignored, can transform perceived stability into vulnerability almost overnight. Monitoring signals also improves decision-making under uncertainty. The financial system is inherently unpredictable, but data-driven awareness mitigates some of that unpredictability. By observing trends, analyzing correlations, and interpreting shifts in market behavior, a depositor gains context for evaluating risk, determining when to adjust allocations, and identifying institutions that may face heightened stress. It is not about predicting every outcome with certainty, but about reducing the unknowns and preparing for multiple scenarios. This disciplined approach aligns with Druckenmiller's broader philosophy of managing risk through informed, decisive action rather than reacting impulsively to crises after they have already unfolded. There is a psychological advantage to monitoring as well. Actively observing economic and market indicators cultivates a mindset of engagement rather than complacency. When a depositor understands the signals that influence the stability of their funds, they develop confidence in their ability to respond rather than being paralyzed by sudden disruptions. This mindset encourages disciplined, proactive strategies and reduces the tendency to panic when volatility emerges. Druckenmiller's advice implicitly underscores that financial security is as much a product of mental preparation as it is of procedural safeguards. Awareness breeds preparedness, and preparedness breeds the ability to act with clarity and precision. Monitoring signals also provides an opportunity to identify advantages beyond risk mitigation. Shifts in interest rates, liquidity, and market sentiment can create opportunities to optimize cash placement, negotiate better terms, or take advantage of promotional offerings that may not be widely visible. In this sense, vigilance transforms protective measures into strategic positioning. It allows depositors not only to preserve wealth, but to manage it actively in a way that leverages emerging conditions to their benefit, enhancing both security and efficiency. Ultimately, closely observing economic and market signals is the lens through which all other protective measures gain context and meaning. Limiting deposits, diversifying, remaining alert, and not relying solely on insurance are all essential, but without situational awareness, they risk being static measures in a dynamic environment. Monitoring provides the intelligence that informs timing, allocation, and strategic response, converting a set of protective practices into a living, adaptive system. It embodies Druckenmiller's principle that risk is continuous and that the ability to read, interpret, and respond to signals is one of the most powerful tools for navigating uncertainty in both banking and broader financial systems. Treating cash strategically rather than passively is the final and perhaps most transformative principle in the framework of safeguarding wealth. While limiting deposits, diversifying holdings, staying alert to risks, avoiding over-reliance on insurance, And monitoring economic and market signals all create a defensive structure. Strategy turns that structure into an adaptive, proactive system. Cash is not merely a passive store of value, it is a resource that can be deployed, positioned, and managed to maximize both security and flexibility. For Stanley Druckenmiller, who has spent decades observing how fortunes are made and lost, the way one treats cash reflects both foresight and discipline. It is not enough to let funds sit idly in a bank account. Strategic management ensures that cash functions as both shield and tool, ready to respond to changing conditions with precision. Strategic cash management begins with allocation. Not all cash should sit in a single account or within one type of institution. Some may reside in FDIC in deposits across multiple banks, while other portions can be held in short-term treasuries, money market funds, or liquid investment vehicles that balance accessibility with security. Each allocation carries its own risk and reward profile, and the purpose is to create a layered system in which cash is protected against institutional failure, market volatility, and operational disruptions. Druckenmiller's philosophy emphasizes that thinking about cash strategically is a proactive act. It is positioning resources in anticipation of uncertainty rather than reacting to it after the fact. Liquidity management is a key component of treating cash strategically. Accessibility matters as much as security, because crises are often defined not by the loss of value, but by the inability to access funds when they are most needed. By structuring cash across accounts and instruments with varying degrees of liquidity, depositors create a system in which critical needs can be met immediately while other funds remain insulated from potential shocks. This approach requires careful planning and ongoing attention, ensuring that cash is not only safe but also functional as a tool for both daily operations and unexpected contingencies. Strategic management transforms cash from a static asset into a flexible, responsive resource capable of adapting to rapidly evolving conditions. Another aspect of strategic cash treatment is risk anticipation. Cash is vulnerable to a variety of threats, including banking failures, inflation, cyber attacks, and regulatory delays. By positioning funds strategically, depositors can mitigate these threats through diversification, timing, and alternative vehicles. For example, staggering deposits to ensure none exceed insured limits, holding funds in institutions with different operational models, and incorporating non-bank alternatives all reduce exposure. Druckenmiller's perspective underscores that cash management is not simply about accumulation, but about intelligent deployment. Structuring resources in a way that anticipates threats before they materialize. Strategic treatment also incorporates adaptability. The financial landscape is dynamic, and conditions that are stable today can change abruptly. By treating cash strategically, depositors can adjust allocations in response to market signals, interest rate movements, or emerging risks. This adaptability requires awareness, analytical thinking, and the willingness to act decisively. It is a principle that echoes throughout Druckenmiller's investment philosophy. The ability to respond quickly and intelligently to changing conditions often distinguishes those who preserve and grow wealth from those who suffer avoidable losses. Cash in this sense is not static, it is a dynamic instrument whose utility is maximized through informed, timely action. Psychologically, strategic management of cash instills discipline and reduces the risk of complacency. Leaving funds in a single account or treating them as inert creates a false sense of security and diminishes attentiveness. In contrast, actively managing cash encourages regular review, analysis of institutional health, and engagement with broader economic trends. It fosters a mindset of preparedness, transforming the individual from a passive participant into an active guardian of financial stability. Druckenmiller has consistently highlighted that mindset is as critical as procedure. Knowing that your cash is positioned intelligently reinforces confidence and promotes deliberate, calculated decision-making. There is also a tactical advantage to strategic cash allocation. By maintaining visibility over available funds and their positioning, a depositor is prepared to seize opportunities that may arise during periods of market volatility or institutional stress. Strategic cash is not only defensive, it is also offensive. It allows a depositor to act quickly, moving resources where they are most effective, whether that means transferring funds to safer institutions, capitalizing on high yield opportunities, or meeting urgent obligations. This dual functionality, protection and opportunity, elevates cash from a passive store of value to an active instrument in wealth management. Finally, treating cash strategically emphasizes the interconnectedness of all financial practices. Limits on individual deposits, diversification, vigilance, avoiding sole reliance on insurance, and monitoring signals all converge when cash is actively managed. Each principle feeds into the others, but without strategic treatment, these measures risk being disjointed or reactive. Strategy provides cohesion, turning a series of defensive actions into an integrated system designed to protect, preserve, and optimize resources. In Druckenmiller's approach, strategic cash management is the capstone. It embodies foresight, discipline, adaptability, and active engagement, ensuring that money is not simply stored, but positioned intelligently to withstand uncertainty while remaining ready to capitalize on opportunity.